Federal Reserve interest rate decision, probably the most important day in the last 3 years. And what's going to happen today? Are we going to have no cuts, 25 basis points, 50 basis points? And what does that mean for your portfolio? What are the long-term allocations and what do I expect to happen in the next half a year or year from now? If you are curious, I'm going to make it today short and concise, 15 minutes max. Stay tuned and let's go. Good morning, good afternoon, everyone. My name is Russ, and today our macro weekly update and a very important day ahead. For everyone slightly new to the world of macro, since I want to make my content accessible, just to give you a reminder, we are in unprecedented times when since 2021, 2022, we've been hiking interest rates. And long story short, today is the day when Federal Reserve is about to change the rate first time in a number of years downwards. Why so? Well, because Canadian, European central banks and others have been already doing so. We see on the media Elizabeth Warren is urging Fed to cut not just 25, not 50, but 75 basis points, 0.75%. And what's so wrong about it, you would ask? Well, the lower interest rates are great for smaller businesses, are greater for the businesses that don't have the crazy huge cash pile like Apple or Google. So that's easier for them to operate in those environments. Well, the main issue is the fact that inflation is still not combated. And if you ask me, I believe that despite the Fed is bringing 2% target in every press conference, either official or unofficial like in Jackson Hole, the problem is they are not going to follow that target. I repeat it once again, the 2% target is the target for the press and for the paper reports. I do not think that this is the realistic target. Here is the inflation breakdown for August 2024. All brought to you by CNBC in one chart. And if you see eggs, of course, plummeting 28% plus, juices, drinks, sausages, everything is significantly above, I would say 3 or 4%. Then we have food away from home, and there is also much more than 4% growth. Well, we supposed to at least nominally follow the 2% guideline. And only position which is down is energy, and that's of course related to the oil prices that been favoring this decline over the last months. We all know those, especially the people who follow me in the Telegram alert group. We've been following oil quite closely, and we're gonna start building the position very soon. And then if you come to the world of other services, vet services, cigarette smoking, laundry, hospitals, I do not understand how out of all these numbers we can come up to 2.5% all item estimate. And that's not to mention that Federal Reserve already has changed the methodology over the last 2 years, and they completely rewired all the denominators for inflation calculation. So even with the new denominators, it sounds like a magic that we are within 2.5, 2.6%, but even those 2.5, 2.6%, we have been 0.1% ahead of the forecast. So even with all this financial engineering and all the magic that Fed brings to the table, we still cannot meet the forecasted targets. And what I mean is that just a week ago, Wednesday, September 11th, core CPI came above expectation, 0.1% above expectation. And then the day after, on Thursday last week, core PPI came above the expectation, both PPI itself and the core PPI month over month. So in both cases, we had an increased actual vis-a-vis the forecast, and we had the forecast which was significantly higher than the previous months. So how does that look like? For me, it does not look good. For me, it looks like in this environment, you at least keep the rate or you potentially raise. But that's going to be misaligned with other central bank moves. And of course, as we know that all the central banks are trying to debase their currencies and they have to act in an aligned manner. And that's why we have those warning letters from Elizabeth Warren. Now, let's look at the job data, because on one hand, we have CPI and inflation, which is forcing Fed to keep the hawkish stance. On the other side, we have the jobs, unemployment, and recession. So if they keep it too tight for way too long, then we might not achieve the so desired soft landing. And in this case, the recession would hit significantly faster. Just in a parenthesis to let you know, we would never know ahead of time that recession is coming. No one gonna come on CNBC and let you know the next 3 months we're gonna have a higher chance for inflation to step in. In 2009, we only realized that we are in a recession at least 2 quarters along the journey. So that's also important to be vigilant here and to not underestimate how hard is it to predict recession. All the Goldman Sachs, all the JP Morgan bros that have been waiting for recession since 2016 have been sidelined. After 4 years, some of those portfolio managers were substituted, but that's not making our job easier. It simply means that if you're gonna try to time recession always, most of the times you would miss the crazy gain days. And if you remember, guys, last week, at least for my portfolio, I had 2 days and portfolio did 6 to 7% intraday in a day. That's a good half a year return for most of the larger portfolio managers. And that's thanks to our junior silver miners. So let's park here for now and see what happens on the job market. For the most recent data, we need to acknowledge that first of all, JOLTS job opening came below the forecast. That raised concerns of the investors, international investors as well, not just the US investors. Unemployment claims came fine, but then unemployment rate went above the forecast. Unemployment change was negative vis-a-vis the forecast. Average hourly earnings also signified the risk of inflation to stay in place. And those were the warning signal that job market is not going quite well. And on top of that, the wage price spiral is about to emerge. And that's a very warning signal for stagflation. And so what happens in this case? In this case, as you see, the macroeconomists started to price the forecast for the federal meeting of 18th of September, which is today. That's why, guys, I'm giving you this contact as soon as possible with the most actual data. It is right now pricing 63% probability for the 50 basis points cut, which was not at all the case. Just a week ago, it was 14% versus 86. So that number here, which is 37 right now, used to be 86. So market is considering that 50 basis point cut today is much more probable. And maybe those warning letters from Elizabeth Warren was one of the reasons, that one of those hidden hints that give Jerome Powell a right to say, well, there are a number of congressmen and politicians that urge me to act, and despite being very vigilant about inflation targets, I have to admit we need to save economy for the US people to prevent the huge company firings and so on. Going to the St. Louis Federal Reserve website, there is one indicator that they like to use when it comes to predicting recession, and this is the SAM rule recession indicator, which actually takes an average of 3 months unemployment data, and right now it stays at 0.57. Well, it doesn't tell you much, but the simple definition of this indicator will be the following: if we are jumping by 0.5 basis points from our 12-month base, then it is very likely that this indicator would reach 1.9. So out of our last 12-month base, which was slightly around 0, we are already more than 0.5% up. 0.5 up means 1.9 would follow. And 1.9, if you can see those gray bars on the chart, those gray bars represent recession. So bringing us to 1.9 territory would definitely mean that everything, and very often, as I mentioned 5 minutes ago, backward looking would be considered to become a recession. So we have to be very careful here. So to sum up, you see On one side, we have inflation that doesn't want to go down. On the other side, we have a recession probability that is percolating. And now you're gonna ask me, Russ, all right, so much of macro information, thank you so much, but what do I do with all of that? Well, let's go into the charts and see from here. And here I should start probably with the chart that would affect the most the traders, their decisions, the global financial liquidity flows, and so on. And obviously, not a surprise, we are talking about the dollar strength index. Why it is so important? Well, first of all, because just in the last 5 years, throughout 2019 to now, the net international investment deficits of the US have been increasing from 10 trillion to 20 trillion US dollars. So that's a double amount of capital that foreign investors are sitting on top of the US market, mostly in the form of unrealized gains. So if today we're gonna receive this 50 BPS cut, it might signal for them that US economy is having a little problem. So what's gonna happen to the majority of those unrealized gains? Well, they will be realized and probably brought to the local economies. This is something I personally would not like to see, because that can have quite a domino effect and a little bit of ugliness into the markets. And I think that despite all, I would still consider that 50 BPS is the most probable scenario. But I think the US will try to keep the dollar for now a little bit up, and that's why we might have this bounce here to my yellow lines that so far since last couple of years have been impeccable in showcasing us the levels of high volume nodes, and other factors are playing in. If we're gonna look at the British pound versus dollar, you would see that multiple divergences are being printed here, but British pound is not yet surrendering, and absolutely the same story with the European currency, with euro. So I would normally expect dollar, first of all, to go significantly down from here. I would see dollar in the next 3 years in the area of 91. That will be my target, and that's very good for the risk on assets, right? That's very good for the risk on assets, namely, of course, BTC, especially now with the Bitcoin dominance all the way towards 60, and it's of course very bullish for our favorite commodity, which is silver. That's kinda gonna give us a plan from now. Now, if you're gonna ask me, Russ, but what's gonna happen today? How do I need to trade it today? Well, first of all, I have to tell you guys, you don't have to trade the FOMC fund rate decision, because even if you're a professional trader, 10 years in the market, it's better still to wait, unless you are scalping on 1 minute time frames. It's way better to wait for the decision to take in place and for those crazy volatility to get digested by the market. Very often in those moments and those minutes, we can have 5% up and down in Bitcoin, and so it's better to have the longer term plan from here and act accordingly. BITO, or Wall Street related Bitcoin indicator, ProShares Bitcoin ETF, in my opinion, 18, this key line here highlighted in red, this is the level for us to hold, and if this level holds, I would believe that all those smaller gaps would eventually be covered, bringing the Bitcoin price at least, even from those levels of today, at least 10+% up, which gonna be quite beneficial also for Bitcoin miners. I've been like consolidating here with very low volatility, I would say, but looking, for example, at Marathon Digital Holding, one of the stocks that I would prefer to own alongside CleanSpark and Riot, or if you're less risky, VGMI is the good ETF from Valkyria that incorporates multiple other companies. But looking at Mara, it starts to look like this diagonal bottom formation to me, maybe one more down, and then I would like to look at this level, 16.2 for us to break, and then I will be much more confident to add in my position. There is no need to do it now. You remember when we had that candle, when we had this Black Monday event, I was telling you, looking at that candle, I think the liquidity here and all the stop losses of people who were in rush to add to their position will be taken. That's exactly what had happened. So yeah, I was not highlighting much Bitcoin miners and my Telegram group for now. We were mostly focusing on silver, and so far it has been bringing us great results. For anyone interested, that is the type of contact I regularly update the Telegram on. So for example, speaking of silver, I was indicating that this level of 31, if it's not taken and accepted above from the first attempt, then 29.5 would be our level to look at. If 29.5 would be lost, then you're really lucky because you have 200-day moving average at around 26.5. 26, that's where you can add, but very probable that 29.5, and it's actually my game plan from here. I think 29.5 will be respected, and then we have a race towards 35 and even further on to 40. For everyone, to let you know, I am doing everything completely for free. All you need to do is to be Nick's newsletter subscriber, which is somewhat around $30 a month. And I honestly don't know anyone on the internet who provides that much value for that amount of money. If you know, please let me know in the comment section down below. My reason to be here on the channel is to share more opportunities with the viewers, to have a quality macro content that you can make your aware decision within few months or a few years of following me, depending of course on your speed and your degree of involvement. But yeah, my target and my goal in life is to teach more people how to make their decisions so they don't need to look for financial journalists. Oil here is also looking quite good. If you want a target, I would give you the target of 72. This is the line where I'd like oil to get accepted above. Once this target is met and we are able to reclaim it, that's the direction for oil. And that's why I would of course would like to be positioned in One Egg Oil Services ETF, which is lagging quite behind. We are not yet at the level where I just indicated for oil. So yeah, we can wait a little bit. Acceptance above 293, and then all-time highs, well, at least those current highs of 22% are the target. And then of course, all-time highs of 360 is the second target. I also updated Telegram group for those who couldn't follow or missed my signal, even though I cannot be as timely and punctual on YouTube still. Just to let you know, TLT does not behave well in a higher inflation environment. So I closed 75% of my position here on the heights around 100, 101. It is still really good. I think majority of assignment we got here between 91 and 93. So it's not bad. It's 10% move within a month or two. And on top of that, if you remember, I was telling you, you get the payouts of roughly 3.8, 3.9% distributed monthly. So you got another roughly 0.6% on top of the move of 10% that you had. So great trade closed here. No need to overset it. I think there's much better trades. For example, don't sleep over Russell 2000. Russell 2000 is gonna behave much better than TLT in an environment which is on one hand side having the rates cut, on the other side where inflation is still not combated, and that would constitute to the growth. Speaking of which, Atlanta Fed just came out with the new GDP estimate, and it's sitting as of yesterday at the whopping 3%. So now time to wrap up and sum up. My view is the following: we're not gonna receive the recession just yet. We're not either gonna combat an inflation, and partially that twickled and tricked inflation would constitute to a bit of extra growth here and there. So I am not joining the recessionistas camp. I am not joining the camp of all the people who've been sidelined since 2016, predicting 2 out of 22, or 22 rather out of 2, that will be more accurate, financial crises. And moreover, when I speak about recession, please don't confuse it with the black swan events We might not have the black swan event, we might have the black swan event, but it's not so important for now. If silver dumps together with the broader market, I would add, I see that extra liquidity that's going to be provided to the market would find and its way and spill over towards commodities. So that's the good thing. And also, I think that 6 months, 9 months from now, Federal Reserve would come back to inflation conversation, because inflation is not yet combated, it's sticky, it's bringing us to the wage price spiral and so on. They might change the methodology once again, but for now, for the next 6 months, I think the asset prices, especially the risk on asset prices, are gonna be benefiting from whatever gonna come today, and my bet is 50 basis points cuts. With all that said, guys, I'm gonna provide for Telegram subscribers much more up-to-date information. We're gonna trade those markets both directions. I promise, gonna have a lot of fun. Everyone stay safe, much love, and I see you soon. Bye.